Today's market report is September 11. Okay, so first off, we'll kickstart the events as usual for Monday. Now, today I would like to talk about the rate cycle. What usually is to be expected when the rate cycle is coming towards an end. Okay, so I think this is a very interesting discussion to have, and yeah, let's move forward to it. So what you have here is a table of the rate hikes that started in year 2022, i.e. last year till now. Okay, so it started in March 15, 2022, where the Fed first raised its interest rates by 25 basis points. And then here is the targeted range for the interest rate hike. Now we are at the 5.5%, between 5.25 and 5.5%. So what's next? What is expected next, right? So we have had 11 hikes since March 15, 2022, and unless we have inflation rearing its ugly head again, we should see another hike at most before the Fed ends the rate hike exercise for this cycle. Okay, and we have also discussed previously that the coming September FOMC meeting, we do not expect any rate hikes, but after that there's this possibility. Now, if this week on Wednesday we have data showing, especially the CPI year-on-year, still showing there's an increase in the rate, in the inflation, the CPI, it goes to 0.6. The month-to-month CPI goes to 0.6 versus previously a 0.2. Then I believe we would have another rate hike coming, okay, in the next FOMC meeting. Not this one, but the next one. Okay, but if there is a real surprise, a real jump, a huge jump, more than 0.6%, that can just change, and then immediately we could actually see that even this rate hike cycle, we might see one. There is this possibility that I cannot discount the fact that it could happen. Okay. Now, rate hikes have brought different behaviors to different asset classes. Here's a look at 3 asset types, which is the indices, the dollar index, and a bank stock, and its possible movements. Okay, so I will discuss this, and then like when a rate hikes, what happens, and then when there's a rate cut, what happens. So you have an idea, and you can deal with these 3 different asset classes. Okay, now first I want to talk about the indices, which is the really world famous one, and it's heavily traded. That is the SP 500, right? So first of all, we will understand what are the previous movements of the S&P 500. Now, as the Federal Reserve starts its rate hiking cycle, the S&P 500 tends to rise. The moment it starts a rate hike cycle, it tends to rise. And just before the end of the cycle, it is not uncommon to see the S&P 500 dropping. Okay, that is its habit. Rate cuts usually see the S&P 500 move up unless, now this is the keyword here, when there's a rate cut, S&P 500 usually move up unless we have a very serious economic issue. Okay, if it's something normal, it's not like a full-blown crisis. Give you an example, a full-blown crisis would be a crisis like 2008, where it's the entire failure of the banking system, or what we have is like the COVID pandemic. Then it's a different case. It's a different case. Then we will call those like something serious. Okay, totally. If it's just a normal crash, a normal cycle, the normal business cycle, then it's different. Okay, so in this scenario, when we have the serious economic issue, the market only rises at the end of the rate cut cycle. Okay, it still rises, but at a different time. Okay, got it? Cool. Now, the next, I want to discuss what do we have right now, which is the current structure of the market. Now, structure-wise, we are seeing an uptrending market in the S&P 500, but we are also seeing signs that the market is fairly uncomfortable with high interest rates, right? We have seen the market, the S&P 500 actually coming down already. Now it's correcting up again. So basically, it is following this particular past movements where the Fed starts its rate hiking cycle, S&P tends to rise, and just before ending the cycle, it's uncommon to see S&P 500 dropping, right? So we are actually seeing this possibly happening. So any whiff of a possible further rate increase that might happen if on Wednesday we have a very high CPI number, this can send the S&P 500 tumbling, which also fulfills the previous habits that it has been repeating again and again after each rate hike cycle. Okay, so you understand the S&P 500. Okay, so now let's move on to the next one, which is the US dollar index. Now, previous movements of US dollar index, how do they move? Now, we see prices rise first during the initial rate hike and come down midway of the rate hike cycle. Now, there are two types of movement that I've detected. Now, I'm just explaining the one that we are seeing, because this probability of price rising during the initial hike and countdown midway only occurs 30% of the time. But current movement seems to suggest this is the movement that we are probably looking at. So when a rate cut announcement is made, the dollar index usually comes down. Then what it does, it creates huge swings. When I talk about huge swings, is this: it comes down and then it creates huge swings. Or when this swings is done, so it's like a consolidation phase. When they announce a rate cut, then when it's done, it will then come down again, make a new low, take out all the lows of the consolidation before it goes up. Okay, so expect this kind of movement. Yeah, okay. So current structure, what's the current structure of the dollar index? Structure-wise suggests the US dollar index is in a corrective movement, and down move is expected when this corrective movement is over. Okay, so this is very, very interesting. So we have to wait a bit because it's already coming down. It's coming down already. See, it's a countdown midway initial. So we are at this phase right now, come down midway. So the moment they announce that that's a rate cut, then you will see those big swings happening. Okay, so finally, I want to discuss, we have done the S&P 500, we have done the dollar index. Finally, I want to bring in a stock, and the stocks, I want to bring in something that is, interest rates affects it the most, and that is nonetheless the banking stock. So the stock that I want to talk about, share with you all, is the Bank of America. Its ticker symbol is BAC. Okay, now previous movements of BAC, now we either have price coming down or moving sideways the entire duration of the rate hike process. And the moment the Federal Reserve cuts its interest rates, BAC then gradually rises. Now this is very interesting, right? And what is the current structure of the Bank of America? Now, BAC has been coming down as high interest rates cause chaos in the US banking industry. See, it's happening again, right? Structure-wise, BAC would probably make another low, breaking 26.32 before it's ready to move up. Now, this is interesting. Because why? If it moves below this low and it comes down to probably below even 25, and then if it's able to even come lower below 20s, it will be interesting, because what you can do, you can start building your buys there, and at the same time make very good dividend returns for yourself, right? So it's interesting. And when that happens, right, you can build this, you can also trade this, because we would have a huge swings. So this too, it can be done. So you can fulfill the part of the short term, and then build a longer term right here too. Take advantage of all the entire movements. And that is the short sharing we have today for the fundamentals.